Spotify. Hey everyone, it's Aaron Morrow again and Brian LaFlame again, the realtor and the lender guy, Washingtonian. Anyways, you got enough goofery with the intros here. You know what you've come here. You've come to listen to either real estate talk, mortgage.
You know what you did to come here.
Yeah, you know what you've done.
This is your punishment.
Yeah. I even put out some posts to even warn you what this one was about. Anyways, so yeah, we're definitely going to talk about the Fed meeting, and you know what? This is all Brian. This is primarily Brian's going to be talking. I'm here to
make it all
goof
up. You guys have no idea what I'm talking about.
Yeah, you have no idea. No. Yeah, I'm here to entertain. So, anyways, but again, yeah, Aaron Morrow, local realtor, Greater Seattle area, and on social media. This is being streamed everywhere. We got TikTok, Instagram, YouTube, Facebook, LinkedIn. I love you, LinkedIn peeps, and my Clapper peeps. Got you as well. So, yeah, reach out to us with any of your questions and comments. Engage in the chat about any questions you have about real estate that aren't even related to what we're going to be talking about here. But we definitely will be diving into this subject matter. Brian, what are we talking about today?
I don't know. We're talking about, so the Fed had a Federal Open Market Committee meeting on the 31st or the first.
Okay.
So what happens when they have their Federal Open Market Committee meeting? So in January, this is January's meeting. They met for a couple of days, and then they come out and they issue a statement. And the statement says where they're looking at monetary policy moving forward. And they also will say whether or not they're going to raise, lower, or keep the same the Federal Open Market Committee's target rate. So we've gone over before what the federal funds rate is. And the federal funds rate is the overnight rate that banks lend one to another or to the with the Fed in what's called either the repo or the reverse repo markets. And so it's kind of the cost of short-term money. And the way that it affects mortgage rates and why is because currently for the past 4 years or so, since the beginning of the pandemic, which was, 4 years minus 1 month ago, it's crazy. The Fed, I lost you there, Aaron. You lost me. I'm going to keep going. The Fed's federal funds rate and their quantitative easing or quantitative tightening has shown kind of where they see the market going and what actions they're going to take. So that's why the federal funds rate has been so forefront to mortgage interest rates for the past 3 or 4 years. The Fed dropped it from 1 down to 0 in March of 2020 at the very beginning of the pandemic. And then in March of 2022, they gradually started raising their federal funds rate until now it's at 5.25 to 5.5. So they kept it the same. I don't have you, Aaron, so I'm going to keep talking about this, what's super interesting to me stuff, but might be boring to you guys. And so the important thing, though, was so that the FOMC, the Federal Open Market Committee, it was in the cards what they were going to do. We knew that they were going to keep their rate the same. Oh, no, we lost Aaron, so it's just me. We knew they were going to keep the rate the same. What we wanted to see was what they said they saw coming forward and when they saw potential rate cuts or maybe even an end to quantitative tightening. So they put a statement out. The statement was very different than the one they had before. And we have a Facebook group for our professional real estate partners where we juxtapose last statement to this statement every time a new Fed statement comes out. But the important part is then Chairman Powell, the chairman of the Federal Reserve, has a press conference where he gives a prepared statement and then takes questions and answers. And that's where the market really moves. And the market moved very positively yesterday. He had some more, hey, we're not quite there where we want to be to start cutting interest rates, but a pause makes sense. He said some things today or yesterday. He said we're not looking for a slide in employment, but would cut rates if we saw some weakening, which made today's report, non-farm payrolls report, much more important. And today's non-farm payroll report came in very strong. We added about 365,000 jobs, and we are anticipating adding about 353,000. The unemployment rate went down or stay the same at 3.7. We had expected to go up to 3.8. And the big number was average earnings month over month increased by 0.6%. We had expected it to increase by 0.3%. So it was a the numbers doubled expectations, and the market sold off a lot. Let's see what that is. So that's what happened with the Fed today, guys. Yesterday, mortgage interest rates really rallied. We have rallied for the past 2 weeks. And after rallying for the past 2 weeks, we've given up a lot of gains today on a very strong jobs report. If you ever want to look at what's probably going to happen in the mortgage interest rate market, if there's positive news in the economy, it's normally negative for rates or bonds. And if there's negative news in the economy, people normally will have a flight to safety, which means that they'll want to be in sort of kind of super low risk investments like Treasury bonds and mortgage-backed securities. That'll bring demand into that market and bring interest rates down. So for now, on the 10-year Treasury, which really closely.
Hey, Brian, I'm back. I am not sure.
The whole time, or was I talking to nobody?
No, you know what? I'm not sure. Hold on. Let's see here. Is the stream going on? Let me double check.
It says live on my thing.
I'm going to check LinkedIn real quick to make sure that it's still going on. Hold on. Yeah,
Well,
I am not sure what. Hold on. Anyone in the chat, let us know if it's going on here. I think I had an issue with Instagram on our end. Nope. I'm going to check real quick. Let me go over here real quick.
Well, at any rate, we are still on. So I don't know if it cut out for a while there, but we're still on now. So we talked about what the Fed had said. We talked about kind of the mechanics of what a Fed meeting looks like. We have the meeting, and then you have the statement, and then you have the press conference, and the chairman speaks on a prepared statement, and then he takes questions and answers. And he was very what's called dovish. You could be hawkish or dovish, and dovish is more softer monetary policy. And the market really reacted very well. There were a couple of big swings yesterday during the press conference, but we had a huge day and a lot of gains. And then I was saying the 10-year Treasury most closely tracks the mortgage interest rate market, kind of move in tandem a bit, like a dog and a leash, really. And so in the past week, we've gone from 4.16 last Friday. That was the yield on the 10-year Treasury, all the way down to 3.84 was, I think, our bottom yesterday, maybe 3.86. And today, with a really positive, really strong jobs report, we're back up to 4.03. So we're having a real bad day today, bad interest rate day today, but it comes in like we're playing with house money. You've been winning at the table for the past week and a half, and rates have come down and down and down and down. And now you get a day where the market was kind of prepared. I think it had gone down so dramatically. It was kind of prepared to maybe take some profits, take a breath. And then this very, very strong jobs report threw some gasoline on the fire. So I want to talk too about what's kind of keeping interest rates down and keeping interest rates moving down. As inflation continues to come down, that's going to be super important next week's when does it come out? 2 weeks from now, Consumer Price Index inflation report. The market's really going to be watching that after this jobs report. So we've had a good move down, and I think we probably stay a little steady, waiting for that data to come in. But what's kept interest rates down is supply and demand. So we have two things right now. We have the Treasury supply and what they call their refunding supply. So how many treasuries are going to be putting on the market. They brought that number down by 50 billion, which had already come down by about 80 billion and what they projected. And so that rallied because less supply coming on the market makes it more valuable. Of course, there's less to buy. We want to buy it more valuable. Secondly, a thing called the reverse repo market. So the reverse repo market is kind of like the Fed savings account. And what happens with the federal funds rate is banks will either send collateral to the Fed to borrow money, or they will send cash to the Fed to take collateral. That's a repo and a reverse repo market. They either buy or they sell. That's the biggest difference. And that market has been coming, that bank account, so to speak, has been draining quickly at the Fed. The reverse repo market looks like it's going to be around zero in that account by this summer. So we've gone down from, I think, about 2.4 trillion down to about 600 billion right now, which is not big numbers for Wall Street. And
Yeah.
so
Yeah.
that means one of two things. Either the Treasury is going to have to sell a lot more treasuries and find a buyer, which means that interest rates will go up. And I can't
Right.
imagine interest rates will go up, as Janet Yellen, the Treasury Secretary, has been pretty clear that interest rates over 4% are untenable. 10-year Treasury yields over 4%. That's interest rates in the 7s to 8s for mortgages. Or the Fed is going to have to buy some of this collateral so we can have the reverse repo market running healthy again. And I think that's probably what's going to happen, which means that quantitative tightening will be over, and quantitative easing will have started in some way, have been underway in some way. This is probably really boring. This is so exciting to me. And I bet we have eyes glossed over. We should have done. I'm going to do a better job explaining. I have charts and stuff, but on a podcast, that doesn't really help. What you need to know is the supply in the Treasury market has started to come down, and that's what's been sending the interest rates down, because you bid on it more, because there's more buyers and less assets to sell or to buy, excuse me. And that's been driving interest rates down. And that happened after our real big run up last year, when the debt ceiling was taken completely off in the summer last year. And then we added $2 trillion in debt. We were downgraded by Fitch in our credit rating, and we had a dearth of supply going into the market up until the spring, when a couple of things happened. We got to 5% on the 10-year Treasury. Up until the fall, we got to 5% of the 10-year Treasury, 8% of mortgage interest rates. Janet Yellen came out and said, hey, this is too high. We can't. The amount of money that the American government spends on interest to service its debt is astronomical, and just gets untenable as we get higher and higher in Treasury note rates. Because the Treasury is just an IOU. So it's the government saying, hey, I owe you money. You're going to give me money now, and I'm going to give you money in the future with interest. So they're borrowing money from you and backing it with us, the taxpayer, the full faith and credit of the United States. And so the higher that interest rate goes, the less they're able, the more money goes towards interest, and the more that hurts our economy. So Aaron's out again. And I expect interest rates are going to continue to head down. We had some interest rate predictions a couple of shows ago, and I expect those to continue to play out. The market is moving like we thought it would. It had a little bit of an upward trend during January, but we didn't think that was too big of a deal. And it turns out that it wasn't, as a reverse course. And I think we're still really nicely within outside of that upward trend in interest rates. And I don't think that we're going to be headed appreciably back up. But there is always a chance something could happen. There's a show that we're going to do soon on the commercial banking crisis that is happening in our country right now, and how that's probably going to affect interest rates as well. Guess who's
Okay, I'm
back
back,
again?
but man, this stream is crazy because Brian, I think it keeps taking you out of the stage when I leave, so I'm not sure what's
No, I
going
talked
on.
for a while, then it kicked me out, so I came back and it put me backstage. It's all right.
Okay,
Mama said there'd be days like this.
Yeah, definitely. Well, I think you know what it's I figured out it's the browser, so
Okay.
I'm not using Mozilla anymore as the secondary browser. I'm gonna have to go back to my Opera web browser. So everyone's live except Instagram right now. So why don't you keep talking? I'm gonna try to get Instagram back in, but
All right.
and I'm gonna
So
try
if
it
there's
with
any questions in the
my
chat about
favorite
what the
browser.
market is, how it's moving, like we said, it's been moving the kind of the way that we expected, even with a real rough jobs number today. Average earnings doubled expectations, and that really hurt us.
Oh, perfect.
We came in at 353,000 jobs, and we'd
They're still
expected
in here.
180.
Good.
We also revised up last month's jobs report from 216 to 330 and November's. So we've had some revisions up where we hadn't had in the past. In the past, we had a jobs number that was kind of killer, really good jobs, and then we'd revise them down in the future. And you have people with their tinfoil hats that say, "Oh, it's a conspiracy by the government." They publish how you could agree with the data or the way they collect the data or where they don't, but they publish how they do it. There's no conspiracy. It's the same. They're super open with this is how we, collect data on the birth death rate of businesses and modeling, which is why there's revisions. This is how we get a business establishment survey, and this is how we do a household survey. We call people in households and say, "Are you working? Are you looking for a job?" We do modeling for businesses for the most part. They're very open, the Bureau of Labor Statistics, but because this affects the market so much and we have so much attention, when it doesn't go people's way, they want to say it's conspiracy theory and the government is lying. And they just, everybody needs a reason to not take responsibility, I think, or if something doesn't work out the way that they want it to now in this world, we think if it's not working out the way I want it to, then somebody must be against me.
Yeah,
Sure.
no, totally.
Cool.
Totally.
That sounds like an exhausting way to live. But the numbers came in hot, and even with hot numbers, we still have a week over week pretty decent gain in the 10-year Treasury market.
Okay. So what do you think that means as far as because again, I got kicked out several times trying to fix the browser on my end with the Instagram was my problem child with the browser.
Maybe you stop going to those websites, and you won't have browser problems.
No. Well, I can't use Mozilla anymore. I'm gonna have to go back to Opera to host everyone on these multi-streamings. It's where it gets finicky when I'm trying to stream to 7 different platforms at the same time. So when I got kicked out, did you speak on how Powell is basically like stating we're not increasing or decreasing right now at the moment?
Yep.
We're just
so we're sticking with. So this is what he said. So I didn't get to this part of it. So the Federal Open Market Committee decided to keep rates the same. We went over a couple of podcasts ago, maybe the last one, the one before, the Fed's dot plot, where once a quarter the Fed publishes where they see each member of the Federal Open Market Committee publishes where they see rates going into the future of the federal funds rate. And they're anticipating 3 rate cuts this year. The market was at 5, was at 7,
Right.
It's come down to 5 in expectations. So he had said the market moved really negatively when he had a statement that said we don't anticipate Fed our first cut to be in March because the market had been expecting a March cut. But what he had said, because he wanted to get inflation down to 2%, that's as measured by the PCE, personal consumption expenditures, and we've had 6 consecutive positive readings on PCE, and we are down in the 2s now. Not at 2%, but down in the 2s. And so he said, he had said that in his statement that they need better data. And so the market in the Fed statement, they said, hey, we need better inflation data and or more good inflation data, one of the two. And what the market took that as is the fight against inflation isn't done, and they're going to continue to tighten and stranglehold the economy as long as they can. He clarified, the last 6 months have been really good. We need just more of that. We don't need better data. We need to continue the good data. And the market swung up on that clarification of, so you're seeing the same thing we're seeing, that inflation is coming down, and it's coming down at a rate that is acceptable to all of us. And it's coming down the way that you would want it to. from the statement that the Federal Open Market Committee published before Powell's press conference, it sounded a bit like the data is not good enough. And he said, no, we just need more. And so he said that about 3 or 4 times. We just need more good data. So we need to continue to follow this. We don't want to spike up in inflation like we had in the early 80s, where you had a big spike in the late 70s, came down a bit, and then spiked right back up. We don't want that.
Right. Okay. Okay.
So he said, hey, we need just more good data. We got 6 months. He said that 3 or 4 times. And then finally somebody asked him and they said, hey, in March, we're going to have 2 more readings before you guys meet again, or 2 more inflation reports before you guys meet again. That'll be 8. You have 6. You said that's not enough. You'll have 8 by then. Is that going to be enough for you to cut rates? Like, he just said, I need more. And people kept giving him a pass on that, saying, what does more mean? Like, you have 6 months now. You're going to have 8 months. Does that mean that you'll be cutting in March if you have 8? And he said he waffled. Of course, he has to. He can't give you a definitive statement other than he wants to stay at 2% inflation. He doesn't want to stay under it. He doesn't want to stay over it. He wants to stay at 2% inflation as measured by the PCE. So that was very positive of him saying, hey, we don't actually need jobs to falter for us to start cutting rates, because that's a big thing people have thought was what they're going to do there.
I mean, that's good. Yeah, we don't need to cripple the economy before we start slashing on rates. Okay.
Yeah,
so
but he also said, but if we do see jobs start to crack, then we will cut. So it was a really
so like so he's definitely saying like, okay, we're not gonna have a nuclear option here, or like meaning like we're gonna not be that stubborn till it gets that bad. But for any reason, if unforeseen events happen where we do see things like that happen, we're obviously going to take a more proactive approach towards interest rates cuts.
Yeah, he gave himself a bit of a like, it's kind of the best answer you could think of. We don't.
Okay.
If not, because if he had said, we're only going to start cutting if jobs start faltering, and then we got this jobs report, we'd have a much worse reaction, because this was a very strong jobs report. And we talked a bit about, I don't know if you're on screen or not, negative economic news is always good for mortgage interest rates and bonds, because investors in negative times, they do a thing called flight to quality or flight to safety. They want lower risk, lower return. They don't want to lose their money. So they move money from equities or riskier investments into bonds like mortgage-backed securities and treasuries. So that's why good economic news, the stock market does well, the bond market not so. And then poor economic news, normally the bond market does well, the stock market not so. That has been a little bit less true the past 4 years because of Fed intervention. So now it's really just Fed intervention trading.
Right. Yeah. Okay. Yeah, no, that totally makes sense. Okay, that's good. Well, then it doesn't sound like it's really doom and gloom or interest rates going way back up into the 8s or anything like that.
No, I think we have such a good reaction to this, and I'm feeling pretty confident about the fact that we didn't break our downward momentum yet. The next 2 weeks are going to be super important, though.
Okay, sounds good. Brian, maybe give a reminder of everyone, since we have anyone that's watching back at this or anyone watching live, where we're sitting right now. I know there's a bunch of variables, but like national rates, where are we right now?
Yeah, we're in the mid to high 6s probably right now for most lenders. That'll cost you a point.
But below 7, guys.
We are below 7. Yep. 10-year treasuries right now sitting at 4.03. It was 4.16 just a week ago, which is awesome. It did get down to 3.86. So yesterday,
exactly.
So we've given a lot back, but that's okay.
Okay.
Yeah.
That's fantastic.
Well, all right, man. Anything else about the Fed you want to know?
I mean, that's my biggest takeaway, is just knowing that we're not going back into a real estate apocalypse, and the market's not crashing, and people aren't losing their jobs left and right, and people aren't becoming homeless left and right, and all that good stuff, especially for our clients, our local clients that are looking to buy right now. I know, I will let you know, it's getting crazier, so I'm starting to notice, like we talked about it last week, but I am starting to notice that bidding war activity pick up again. Had a client, they've missed out on 2 offers where the reason why they didn't win the offer was they weren't willing to waive the inspection. Yeah, so now we're definitely going to have to start bringing pre-inspections back for that client, and that's a strategy that they're going to have to go with, just because they came in highest and best with strong financing, but they just can't the seller wants to go with a more sure thing with, someone that might not come back to them with a repair
If
list.
I were a seller, I would want that too. If somebody's willing to do it,
I get it.
as a buyer, I would also walk away.
Yeah. I get it.
Yeah.
And it's happening. Yeah.
Last month we had 52 people complete mortgage applications.
I saw that. So I saw your post. You were at 49. So you got 3 that snuck in there on the final night.
Yeah,
or whatever,
we got to 52. I really wanted to get
That's
to 50.
awesome.
That is indicative in January, 52 people for our little team here. That's indicative of the demand that's in the market. I think so far in February, we've gotten 5 or 6. It's the second day of the month. Like the buyers are out and moving. And if you're watching this live stream, you don't want to get passed by. So we're seeing the market shift.
No, that's fantastic. I hosted one of my first homebuyer webinars online, like I was talking to you. So I had a pretty decent turnout on that. Like 13 people showed up on that. But yeah, I've been talking to a few people. I have a few calls scheduled today to talk to people from that. But one gal I talked to, she moved from Illinois. So she's been living here for 6 months. She's a data analyst, banker.
Mm-hmm.
But I think just biggest thing is just figuring out if she can qualify. Because I think a lot of people that move over here are a little bit sticker shocked to not only how much rent costs, but then also just how expensive buying houses are over here. You know what I mean?
It is.
And telling people that comparing the rent to, like, comparing the mortgage payment and the rental payment, it's apples and oranges. Like, it's a unicorn if you can find a scenario over here where your rental payment's the same as your mortgage payment. They just don't go hand in hand. Because
next week we're gonna break down that.
I love that. I love getting into the nitty gritty. We should break that down for home buyers and really show them what that looks like.
It is not the right time for everybody to purchase a house. Aaron and I absolutely believe that. It is the right time to look into purchasing a house for you. We absolutely believe that. Maybe it's a yes, maybe it's a no, but you'll know it. Sometimes renting is better. And when we break this down next week, renting versus buying, there'll be some times we're like, hey, this in this situation, you should probably rent a house. There's nothing wrong with it. It's just different. And so I'll do some screen share stuff too, so we can go over what that looks like.
If we get a good enough turnout, we might turn that into a webinar that we can start inviting people to. So
I think so.
But yeah, definitely. Let's do that for our live next week. I had a few. I'm gonna start doing this just since we're towards the end here and we didn't have too much to talk about and no one's commenting. Just kidding. But let me throw in some. I wanted to show you some stuff here. Let's see here. Let me find it.
Oh, okay.
Let's check it out. Yeah. I'm just gonna show. I'm gonna share some clips with you. This comes from this. I'm gonna give credit where credit's due. This comes from a social media Instagram called Homeowner Memes. Here, let me see if I can throw it on the screen. Is it? Why isn't it?
Yeah. It's up. You're up. Homeowner Memes.
Up there. Homeowner Memes. Yeah. Okay. So here's a couple. You let me know if you relate to any of these. Okay. So let's see here. This one,
should make a game for this.
Yeah, I can relate to this one.
Wife is incredibly handy, and when she puts her mind on something, she's fine doing it all by herself.
Yeah.
Yep.
Yeah.
She's just like, I wanted to do this, so I did it.
First thing that Court did when we moved into our house, we had I will say, because it's a matter of taste, but since it was built in 1980s, it had all the stripping and trim was the metal gold,
Mm-hmm.
So like
super outdated, yeah.
Yeah, so the first thing she did was rip out that metal, and she's like, I wonder how long it'll take before we end up replacing the flooring in the kitchen because the strip's gone, And I'm like,
you heard it right away, didn't you?
No, I think I sat on it.
No, but you heard what she was saying to you.
Oh yeah, definitely. And then I can relate to this one. This is really funny.
Good morning. Good morning.
the weirdest anxiety. I hate it.
Yeah.
And I'll tell myself the night before, if I don't put it out, I'll tell myself, you're going to be up early. You'll just take it out early. And then for whatever reason, like either the garbage truck comes earlier or my alarm, I set my calculator instead of my alarm. I don't know. But that sound when you know, and then you rush out and then they're at the next house. And
Yep.
you're like, oh,
you're like, oh, I missed my shot. Especially so like when you live in a
sometimes
neighborhood.
I'll take it across the street and just put it across the street with the neighbors.
Oh, yeah, good idea. Yeah, just put it. No.
Throw them $5 for their extra garbage fee that day.
Give them that extra fee. Yeah, I've had it. Well, I mean, in most areas in here, they do it where the recycling and the compost is like on a rotation.
Yep,
so if you miss a recycling with all those Amazon boxes, that's an apocalypse. Right there.
You may as well go to the dump.
Yeah, that's a dump run right there. That is a dump run. Here's one for all of my savvy investors that are looking to flip.
It's just the beginning. I've seen things you've only seen in your nightmares. Things you can't even imagine. Things you can't even see.
And then this is the final one. I think agents are getting a little too creative with their real estate marketing that they're doing on Zillow.
Oh my God! We're having a fire sale! Oh, the burning! Ah! Oh, May! This isn't a fever! Sing, Gray!
Anyways, when I saw that, I was like, oh my gosh, are those the pristine photos of that? Is that the updated?
Well, you better move fast because this house definitely will not be on the market long.
It will not be on the market for long. Yeah, no, I need to look into what actually happened with that house. But yeah, anyways, you guys, if you're interested, I'm gonna put a link into the chat for you to check out that Instagram account. But I thought it was hilarious to give credit where credit's due. Those were some good memes. But yeah, guys, thanks for coming to this live. Sorry there was so many broadcast issues. I'm gonna make sure that I'm using a more stable web browser next time because Mozilla Firefox was not the way to go to support 7 different broadcasts.
Oh, yeah.
Man, geez Louise. Well, thanks TikTok for showing up, Clapper for showing up, Instagram peeps as always, LinkedIn, all of y'all, YouTube, everyone. One thing here, I've gotten a few different people ask. They've checked out the YouTube playlist for past client video testimonies. I did put together a really quick sizzle reel for y'all, so you can watch it real quick as we close this video out. So I'm going to throw that on the screen for you real quick.
Aaron was so patient with us throughout the whole journey.
Aaron is full of energy, so I appreciate that too. So it was a great experience overall.
He's just a great guy, great agent, and like I said, investor friendly.
The process with you was great. Thanks for all the great recommendations.
It's been a great experience. We've had a lot of fun looking for homes and finally finding one with you.
Aaron's awesome. His team is on point, and would definitely recommend them.
You are a great host. Thank you so much, Aaron.
Yeah. The thing I really appreciate about Aaron is how much he accommodated us.
He's very customer service. He is oriented in answering all the questions that I have, and it's just been such a smooth process.
Working with Aaron has been amazing.
Doesn't know Aaron. He's a fantastic person, and he did a wonderful job in finding this home for us.
I recommend if you need a real estate agent, hit up Aaron. It was great. Yeah, it was so helpful.
All right, guys. Well, thanks so much for coming. If you guys have any questions, please reach out to us. We would love to chat with you about your home buying or selling goals. Even if it's nationwide, we'd love to help you. Just like, who is that insurance company? I just thought Nationwide's on your side. Is it?
It's nationwide. Who is that insurance company that does stuff nationwide and they're on your side? I don't know, man.
I don't know. Is it Nationwide? Yeah. Anyways, guys. Well, thanks so much for showing up again. Aaron Morrow, Greater Seattle Realtor, your friendly neighborhood social media realtor. Brian LaFlame here. All Washington State and Oregon can help you with those loans, and we can help you outside of the state as well. As long as you're in the United States, it gets a little bit more complicated when you're looking outside the U.S., but if you're a U.S. peep, let us know, and we'd love to help you out with buying real estate in the greater United States. This U.S. of A. All right, guys. Talk to you later.